99% of people still don't know the basics of investing. They chase hot stocks, they hoard cash, or they copy whatever is trending online. And that's why most people never build real wealth. But the top 1% think differently. And no one proves this more than Warren Buffett, one of the greatest investors of all time. If you had invested just $1,000 in his company Berkshire Hathaway when he took over, you'd have over $21 million today. Even with market crashes along the way, that's an average return of around 20% per year, compared to just 10% for the S&P 500. In other words, Buffett didn't just beat the market, he doubled it, decade after decade. So what makes the difference? Buffett built his fortune by mastering the basics that 99% of people ignore. My name is Ivan, and I help people understand the psychology and mechanics behind building real wealth. If you're tired of wondering why your bank account never seems to grow despite making decent money, make sure to subscribe to the channel and hit that like button if this video helps you figure out where you have been going wrong. So, here are 9 principles from Buffett that show exactly how the top 1% think about money, and why you should too. Rule 1. Cash is never a good investment. Most people think sitting on cash is safe. They believe cash is king, but Buffett calls cash a terrible investment. Why? Because every year inflation quietly eats away at your money. 10 years ago, a dollar bought more than it does today. In 10 years from now, it will buy even less. Buffett says cash is like oxygen. You need a little to survive, but holding too much will suffocate your wealth. That's why he always prefers owning productive businesses instead of piling up cash. The 99% cling to cash for comfort. The 1% put it to work in assets that grow. Think about it this way. If you buried $10,000 in the ground 30 years ago, you'd dig up the same $10,000 today, but it would only buy half of what it used to. If instead you'd put that same money into an index fund, it could have grown to more than $150,000. That's the hidden cost of sitting on cash. And here's the kicker. Every year you delay investing is another year your money quietly loses purchasing power, which is why Buffett calls cash the worst long-term investment. Rule 2. Invest in productive assets. Most beginners get distracted by shiny things like gold, crypto, or collectibles. But Buffett reminds us, wealth comes from assets that actually produce something. He uses the example of gold. If you owned every ounce of gold in the world, you could stack it into a cube about 68 feet tall. You could polish it, admire it, and sit on top of it. But it wouldn't produce anything. Your wealth would only grow if someone else was willing to pay you more for that same cube later. That's speculation, not investing. Now, compare that to owning farmland. A farm produces crops every year, young corn, soybeans, wheat, and those crops can be sold for income. Businesses work the same way. They create products, deliver services, and generate profits. Those profits are what make the asset valuable. The 99% chase price tags. The 1% focus on what an asset actually produces. And here's the big insight. Productive assets don't just hold their value, they expand it. A farm produces more every harvest. A business reinvests profits to grow bigger. That's why Buffett prefers assets that pay you while you sleep instead of ones that just sit there looking shiny. Rule 3. Stay in your circle of competence. This may be the simplest but hardest rule. Most investors lose money because they buy things they don't actually understand. Buffett says you don't need to know everything. You just need to know your circle of competence, the things you truly understand, and stay inside it. He often repeats a lesson from Tom Watson, the founder of IBM. I'm not a genius, but I'm smart in spots and I stay around those spots. For Buffett, that meant focusing on simple, predictable businesses, insurance, consumer goods, banks, not tech startups he didn't understand in the 1990s. The 99% try to play every game on the field. The 1% only play the games where they know the rules. Think of it like sports. If you're great at basketball, you don't step onto a soccer field and expect to win. Yet in investing, most people wander into arenas they don't understand because everyone else is playing there. That's a recipe for disaster. The truth is, you only need to be right a few times in your own arena. Staying in your lane not only protects you from big mistakes, it also makes your edge stronger over time. Rule 4. Evaluate companies, not stock prices. Most people look at stock prices first and then decide if they want to buy. Buffett does the opposite. He looks at the business itself. When he invested in PetroChina, for example, he didn't start by looking at the stock price. He started by reading the company's annual report. He studied its oil reserves, refining operations, and profits. Only after valuing the business did he check the price. What he saw was a company worth around $100 billion selling for just $35 billion. That's when he bought. Buffett warns that if you look at the stock price first, your brain gets biased. You anchor on the number instead of the real value. The 99% obsess over charts and ticker symbols. The 1% study the actual business behind the stock. Think about buying a house. Would you decide to buy just because the price per square foot went up or down last week? Of course not. You look at the neighborhood, the condition of the home, and the rent you could earn. Stocks are the same. You're buying a business, not a line on a graph. And when you train yourself to think like a business owner instead of a trader, the noise of daily price swings stops controlling your decisions. Rule 5. Play big and don't waste opportunities. Buffett says you don't need hundreds of investments in your lifetime. You only need a few great ones. He gives the example of a punch card with only 20 punches. Imagine every investment decision used up one punch, and once you ran out, you could never invest again. You'd think much harder about where to invest. This is why Buffett says when a truly great opportunity comes along, you don't just nibble at it. You go big. The 99% dabble in dozens of random trades. The 1% wait patiently, then swing hard when the odds are in their favor. It's the difference between spraying money everywhere and making one well-aimed shot. In investing, a few big wins can change your entire financial life. Just look at Buffett himself. Most of his fortune comes from a handful of investments like Coca-Cola, American Express, and Apple. His secret wasn't being busy, it was being selective. And here's the key takeaway. Saying no to average opportunities is just as important as saying yes to great ones. The more disciplined you are about passing, the stronger your punches will be when it really counts. Rule 6. Invest in yourself. Finally, Buffett says the best investment you'll ever make is in yourself. Unlike stocks or real estate, no one can tax away or inflate away your skills. He tells students, imagine I offered you $100,000 for 10% of all your future earnings. That makes you $1 million asset right now. If you improve your skills, your value goes up. Learn to communicate better, and you might boost your lifetime earnings by 50%. That's like adding $500,000 to your net worth without ever buying a stock. The 99% obsess over quick wins. The 1% invest in their mindset, their discipline, and their habits, the things that compound for life. Because here's the truth. Even if you lose every dollar tomorrow, your skills, your knowledge, and your habits stay with you. That's why Buffett calls self-investment the ultimate moat, a defense that no one can take away from you. Rule 7. Think long-term and ignore the noise. Buffett often says his favorite holding period is forever. Yet 99% of investors behave the opposite way. They check prices daily, panic at every headline, and trade in and out as if wealth is built overnight. The truth is, wealth grows like a tree. You don't plant a seed and expect a forest tomorrow. You water it, protect it, and let time do the heavy lifting. Stocks work the same way. Compounding only rewards those who stay invested long enough to see it work. Buffett built his fortune not by predicting every market move, but by buying great companies and holding them through crashes, recessions, and temporary setbacks. The 99% try to outsmart the market. The 1% trust time, discipline, and patience. And here's the part nobody tells you. Most of Buffett's fortune came after his 50th birthday. That's the power of compounding over decades. The earlier you start and the longer you stay invested, the bigger your advantage becomes. Rule 8. Avoid debt traps. Buffett warns that debt, especially high-interest debt like credit cards, is one of the fastest ways to destroy wealth. He once said, if you're smart, you're going to make a lot of money without borrowing. The problem isn't just the interest payments, it's the mental stress. Debt chains you down, forcing you to think short-term instead of long-term. The 99% use debt to buy things that lose value. Cars, gadgets, or luxury items. The 1% use debt cautiously and only when it helps them acquire productive assets. If you're constantly paying 20% interest to the bank, how can you ever expect to compound wealth at 10% in the market? The math just doesn't work. Buffett's advice is blunt: avoid bad debt like the plague. Rule 9. Keep it simple. Most investors love making things complicated, chasing exotic strategies, complicated formulas, or the latest financial fads. Buffett does the opposite. He said for decades that successful investing doesn't require genius IQ or complex models. It requires discipline, patience, and common sense. The 99% get seduced by complexity because it feels smarter. The 1% stick to simple strategies they can actually understand and repeat for decades. Buffett's favorite example, the S&P 500 index fund, he's told most people that simply buying and holding it consistently will beat the majority of professional money managers. Simplicity wins because it keeps you consistent. And in investing, consistency beats brilliance.